Today, we're diving into the recent warnings issued by Jerome Powell, the chairman of the Federal Reserve and one of the most powerful economic figures in the world. His cautionary words about potential future bank failures could herald a looming financial crisis reminiscent of the 2008 disaster sparked by the collapse of Lehman Brothers. This kind of crisis could have significant implications for our investments and savings, making it essential to understand how to protect our capital and navigate these uncertain waters. A new wave of bank failures. Powell's warning paints a picture of a banking system under strain, with many institutions teetering on the edge. The recent spike in inflation and the subsequent rise in interest rates have only compounded the problem. Let's take a closer look at the situation and how it might evolve, as well as the steps you can take to safeguard your investments and even profit from these challenges. The domino effect. The financial system is intricately interconnected, much like a line of dominoes. A single bank failure can trigger a chain reaction across the industry. When Lehman Brothers went bankrupt in 2008, it set off a series of over 500 American bank failures, causing a sharp decline in stock markets, rising unemployment, and a grinding halt to economic growth. Likewise, the infamous 1929 stock market crash stemmed from cascading bank failures, resulting in over 4,000 bank collapses and one of the most challenging economic periods globally. Powell's recent testimony before the U.S. Congress shed light on the current situation. When asked about the potential contagion effect in the banking system, Powell acknowledged that the Federal Reserve is actively monitoring at-risk banks, ensuring they have plans in place to absorb losses and maintain liquidity. Despite these efforts, he emphasized that further bank failures are on the horizon due to three main issues: high exposure to non-guaranteed deposits, a significant share of real estate loans, and the long-term effects of rising interest rates. Understanding the risks. The alarm bells are ringing, and we must pay attention to the Federal Reserve's concerns. To navigate these uncertain times, we need to understand the root causes of the impending crisis and how to protect our investments. Banks' exposure to losses. Over the years, banks have accumulated significant amounts of government bonds in search of higher yields and favorable accounting treatment. Historically considered safe investments, these bonds have seen their value plummet due to skyrocketing inflation and subsequent interest rate hikes. Many banks hold large amounts of older bonds yielding just 2%, while new government bonds now offer rates as high as 5%. This mismatch creates a dangerous situation for banks that may be forced to sell bonds at a loss if depositors demand their money back. Real estate loans. Banks ventured beyond residential mortgages and delved into riskier commercial real estate loans. The pandemic accelerated remote work, reducing the demand for office spaces and leaving many commercial buildings underutilized. E-commerce's rise also diminished foot traffic in malls and shopping centers. As interest rates rose, the value of these properties declined, exacerbating the risk of default on loans. Strategies for protection. Now that we understand the risks facing the banking system, how can we safeguard our capital? Here are some steps you can take. Research bank. Stability. Check banks' annual reports to assess their exposure to risky assets like commercial real estate and government bonds. Focus on their ability to weather potential losses. Diversify your portfolio. As Ray Dalio, founder of the world's largest hedge fund, Bridgewater Associates, recommends, a diversified portfolio with a mix of domestic and international equities and a small allocation of gold, around 10–15%, can help weather economic uncertainty. Consider gold and related investments. Gold historically performs well during inflationary or financial turmoil. You can invest in gold through ETFs, mining companies, or royalty companies like Franco-Nevada, FNV, or Royal Gold, RGLD. Focus on quality stocks. Look for quality companies in essential sectors such as consumer staples, healthcare, and technology. These stocks can provide stability even during downturns. Pay attention to valuations. Look for companies trading at reasonable valuations compared to their earnings. Companies with solid fundamentals and low debt can weather economic storms. Examples of resilient investments. Let's examine some investments that have proven resilient during past crises. AutoZone, AZO. Specializing in auto parts and maintenance, AutoZone thrives during economic downturns as consumers repair their older vehicles instead of buying new ones. Constellation Software, CSU 2. This Canadian software company acquires underperforming software businesses worldwide, improving their operations and profitability. It has delivered exceptional returns over the years. Defensive stocks. Companies like Coca-Cola, McDonald's, and Walmart offer everyday products at affordable prices, making them resilient during economic downturns. What to avoid? On the flip side, steer clear of sectors like airlines, banks, insurance companies, and casinos during financial crises. These industries are typically hit hardest during tough economic times due to decreased consumer spending. The path forward. While these crises are challenging, history shows they can eventually be resolved. Staying informed and understanding how to navigate the markets can empower you to optimize your portfolio and capitalize on future opportunities. Investing wisely and managing risk effectively is crucial. By remaining disciplined and informed, you can position yourself for long-term success. Remember, the journey of investing is a marathon, not a sprint. I hope this enhanced and translated text provides you with valuable insights into the current financial situation and actionable strategies to protect your investments. Feel free to leave a comment if you found this information useful, and don't forget to like and share the content to help others stay informed and learn how to invest wisely.